there's 5 sectors the economy is in, and I look at the second derivative of inflation. So I look at deflation, falling prices, disinflation, where the second derivative is falling, stasis, reflation, and then have hyperinflation or stagflation. Those are the 5 sectors. Now, we are in sectors 3 and 4 right now, where the economy is kind of in stasis or sort of reflation right now. I have to say probably China's stimulus program, draining of the reverse repo facility, has kept us in this out of sectors 1, which is, I said, deflation. Maybe it's the Trump election euphoria. Maybe it was the fact that the Fed cut rates by 50 basis points. So we are in the sojourn in sectors 3 and 4, which is a pretty good place to invest. My thesis is that sometime in 2025, we're going to enter sector 1. So we're going to go back to sector 2 and then quickly to sector 1, which is when you see the repo market, money markets freeze. You can't float commercial paper. You've got a huge problem in the money markets. And that once that gets clogged, you can quickly go to deflation and the chaos. The Fed is not charged with protecting the middle class. They pretend that it's a nice guise, it's a nice ruse, it's a straw man. They are in existence to protect banks. That is what they were formed to do, and that is what they care most about. And they'll say, well, the middle class can't function without well-functioning banks. That's their cover. Okay. They will cut the interest rates back to 0%. They'll end QT, go back into QE. There'll probably be some round of helicopter money. And then I think we're going to see inflation just skyrocket. We'll go to sector 5. That's my theory. I see chaos playing out in a collapse of housing prices and a collapse of the stock market, engendered by a freezing of the money markets, which is deflationary. Those things are extremely deflationary. If you can't float commercial paper, you can't make any short-term loans anymore. You can't borrow money short-term in the repo market. That is the most deflationary thing that you ever have. The economy doesn't function without the money market functioning. What I said, to be clear, was that Wall Street thinks that the Fed's put is back in full force. Every time the Fed cut interest rates, it's not exactly the panacea. Oh boy, the Fed has our backs. So let's just buy stocks. That's the reflex of action from Wall Street, as always. But I pointed out that the last 3 times the Fed cut rates, let's see, 2020 was the pandemic. Fed cut rates quickly back to 0. And the stock market lost 35% in like a few weeks. That didn't work. And then we had 2007 when the Fed started cutting rates by 50 basis points, coincidentally. And by March of 2009, the S&P 500 was down 50%. And it's the same thing in 2001. The Fed cut rates by 50 basis points. About 2 years later, the S&P was down 50%. So I don't understand why people think that just because the Fed is cutting rates, that it's a panacea. It's very common in the past that when the Fed is cutting rates, it's because things are falling apart. Now, it's always the zeitgeist on Wall Street that, well, this time the Fed's cutting rates because it's just precautionary. Housing market's fine and subprime is contained. It's just like an insurance. It's an insurance policy. We're cutting rates by 50 basis points just in case something happens. That's what I heard in 2007 too. So let me give you quickly 3 things that are very, very different this time. I'm not saying the market's falling apart right now. It isn't. I'm concerned because the bond market, I wrote a book about this in 2013. I said, someday the bond market is going to fall apart. And I didn't mean 100 years in the future. I didn't mean in 2014 either. I just said at some point, the Fed is going to have a dilemma where they're going to have to constantly providing low interest rates in real terms. You're going to create eventually inflation, and that's going to send the bond market higher. That's exactly what's happening. This time you have illiquidity concerns, insolvency concerns, and inflation concerns, which are driving up bond yields, which is completely the opposite of what's supposed to happen and what the Fed wants to happen. I think liquidity is running dry. So we have 2 sources of primary liquidity right now. Don't forget the Fed is still doing quantitative tightening. I'm sure they'll end that soon. But they are supposedly doing quantitative tightening at the same time that they're supposedly lowering interest rates. So, the short-term rates, the Fed funds market, and then you have the repo market. But anyway, I'm just saying the Fed is draining its balance sheet right now. That's what's happening. Okay. But you also have the reverse repo facility, which was once $2.5 trillion. This was all the excess reserves, all that money that was printed by the Fed was given to banks as Fed credit, and it was parked back at the Federal Reserve because they were paying interest on this reserves, right? That's gone from $2.5 trillion to $200 billion. And I don't think it's going to go to 0. It's pretty much at 0. It's effectively dry right now. You're not going to see, hundreds and hundreds of billions of dollars coming in every few months from the reverse repo facility. It's just not there anymore. Then you have the Treasury General account. That's going to be drained, I think, by Q2 of next year. And that's, money the Treasury parks at the Fed. I think they're going to have to use that money because guess what? I don't think we're going to have anything to agree on in Washington, D.C. in January. I think we have a deadlocked Congress, lots of confusion and moving parts with the election, but the chances are very high that Janet Yellen's going to have to use those funds in the TGA to keep the Treasury afloat, to pay its bills. And then you're going to have a repo crisis. You're going to have spiking interest rates in the money markets, and that's when this whole thing falls apart. Now, I'm not a Cassandra. I'm not the purveyor of bad news. I'm just being realistic. We had interest rates that were unbelievably low, close to zero, under 1% for 10 of the last 14 years. That created massive distortion in the stock market and in asset bubbles and debt that's outstanding. And there will be a price to pay for that. It is coming. It hasn't gone away. And my job is to time that out as best as possible. Chaos is coming like we've never seen before. Stagflation is coming like we've never seen before. And are you prepared for that in your 60-40 buy and hold target date fund? The M2 money supply is a product of banks, so it's a broader monetary aggregate. The Fed only controls the base money supply, which is the Fed's balance sheet. So there's physical coins and currency in circulation, and then there's Fed credit. That's what the Fed directly controls. So the banks are starting to lend a little bit of that money out, but that's because we just talked about the reverse repo facility. So that credit goes from laying fallow at the Fed, goes to the banking system, and the banks use that credit as a base to make loans. So it shocked me that the M2 money supply is growing from its normal pace of growth is like 6 or 7% per annum. Now it's like 2%. But that's only a byproduct of all that credit coming out of the reverse repo facility and the TGA. That's going to end in 2025. That's just a fact. And then we'll see what happens with the economy. The economy and the asset bubbles in particular, commercial real estate, they have a lot of problems ahead of them. Remember, we have a dysfunctional, frozen, warped, and disfigured real estate market. There's no transactions anymore. You've got sellers that are living in the past thinking that this is like, the post-COVID wave. And home prices are just all-time record high relative to incomes. Then when you add in taxes and insurance and maintenance costs to the house, they're astronomical. And guess what? And here's the primary point. Normally, the Fed saves the economy from a recession turning into a depression by lowering interest rates across the yield curve. And mortgages are kind of pegged more towards the benchmark, 10-year Treasury, right? Well, guess what happens? Since the Fed decided that the economy really needs more inflation and we want to get interest rates to fall. That's what the Fed said. The Fed said that they wanted interest rates lower. They lowered the Fed funds rate by 50 basis points. But when they did that, a funny thing happened. The 10-year note went from 3.6% to 4.3%. So mortgage rates are soaring right now. Not falling, soaring. And so is everything else priced off of long-term interest rates. Okay. So I wouldn't think that this 50 basis points the Feds put and they got your back. I don't think that zeitgeist really works this time at all. It's the opposite. The supply of homes on the real estate market is soaring. The supply of homes for sale. Don't forget, there were many years post-COVID that 60% of all homes were purchased by investors in those years. Yet investors are sitting on a mountain of properties, single-family homes. Wall Street is sitting on a mountain of properties. They are selling now because it's easy. When you think about what an investor has to do, they look at it like a stock. I'm up 60% in this stock in the last few years. I'm calling my real estate agent, hey, sell it. And I don't do anything. There's nothing else to do. I don't have to move. I don't have to get a mortgage. I don't have to tell my wife that we're going to sell the house and rent someplace for a little while. I don't have to do anything like that. I just call my real estate agent and sell it. And that's exactly what's happening all over the country, not just in Tech Florida, where everybody moved to post-COVID. I give up any hope in the central bank to ever do the right thing. I mean, Powell tried. He feigned an interest in doing the right thing, got rates to 5.25% to 5.5%, looked good, but now he's panicking. And let me tell you the real reason why he's panicking. It isn't because the stock market's doing terrible. No, it isn't because the money markets are frozen. They're functioning very well. Credit spreads are as tight as they could possibly be. It isn't because inflation is plummeting. That's not true. It isn't because the unemployment rate is spiking. It's not true. It's way below average. Powell panicked for one reason, because he doesn't want his friend Janet Yellen to pay $1 trillion+ a year on interest payments on the debt. That's it. He can't be honest and say that, but that's the real reason. He doesn't want Janet Yellen to have to pay 20% of all of our revenue on interest payments. Funny thing happened though, Jerome, when you cut interest rates and the bond vigilantes say, oh, oh, Mr. Powell, you no longer care about controlling inflation? Well, then we have to care a lot. And interest payments are going up across the yield curve from 2-year all the way out to, zeros, 30 years and longer. Interest rates are spiking. So our debt service payments will be going up. I own over 10% of the portfolio in gold. I actually picked up silver about a month or two ago. It looked like it was primed for a massive long-term breakout, which is exactly what happened. So if you don't have precious metals, which aren't part of your 60-40 portfolio, right, you're going to be left behind because real interest rates are going to be negative for a very, very long time, years, if not decades. That's my thesis, until we have a clash with hyperinflation. Who would have ever told you when I first got in this business in early 1990s that one day our central bank would print trillions and trillions of dollars in the matter of a couple of years? They think you're completely moronic because back then the Fed's balance sheet was like $100 billion. The entire balance sheet was nothing. So I would sound like a buffoon, like a Cassandra. But that's exactly what they have done. And they were doing it before COVID. Okay, so the Fed's balance sheet was $4.5 trillion. So it was a result of the global financial crisis. So his balance sheet could go to $20-30 trillion. You could have a national debt that has $60 trillion in the next 10 years. We have multiple trillion-dollar deficits every year for the next 10 years. The deficit is going to rise $20 to $25 trillion in the next decade if there's no recession and if there is no inflation. You want to bet me right now that there'll be one of those two things in the next 10 years? So that's what the gold market and that's what the gold and silver market is sniffing out. It's bond market chaos more than any, and real interest rates being negative.
Michael Pento presents a deeply pessimistic view of the current economic landscape, highlighting several critical insights: economic cycle and potential crisis. Michael Pento believes the economy is currently in a stasis or reflation phase, but predicts a significant downturn in 2025. He anticipates a sequence of economic events that could lead to 1. A potential freezing of money markets. 2. Deflationary pressures. 3. Potential chaos in financial systems. 4. Eventual hyperinflation. Federal Reserve criticism. Michael Pento argues that the Federal Reserve is fundamentally misunderstood. 1. Its primary purpose is to protect banks, not the middle class. 2. Rate cuts are not a guaranteed solution, citing historical examples where rate cuts preceded market crashes. 3. Current monetary policy is creating more problems than solutions. Liquidity concerns. Michael Pento points to multiple signs of diminishing economic liquidity. 1. Reduction of reverse repo facility from $2.5 trillion to $200 billion. 2. Potential draining of the Treasury General Account. 3. Quantitative tightening, continuing alongside interest rate adjustments. 1. Real estate and market risks. Michael Pento highlights significant risks in the real estate market. 1. Dysfunctional market with frozen transactions. 2. Investors selling properties en masse. 3. Mortgage rates increasing despite Fed attempts to lower rates, debt, and inflation outlook. The analysis suggests a bleak fiscal future. 1. Potential national debt reaching $60 trillion in 10 years. 2. Continuous trillion-dollar deficits. 3. Likelihood of sustained negative real interest rates. 4. Potential for long-term stagflation. Michael Pento recommends diversifying investments, particularly suggesting allocation to precious metals like gold and silver as a hedge against these predicted economic challenges.